In the dark alleys of finance, history has a way of repeating itself. The instruments of deception may evolve with technology, but the underlying desires that drive them, greed, hubris, the relentless pursuit of wealth, remain eternal. Our modern era, fueled by the relentless pace of innovation and the siren song of digital assets, has proven to be fertile ground for the resurrection of old crimes in new guises. We stand at the precipice, where unprecedented opportunities for growth collide with ancient vulnerabilities to fraud. The promise of decentralization, of democratized finance free from the shackles of traditional gatekeepers, became for some merely a new façade for the oldest trick in the book. From the roaring 20s speculative bubbles to the dot-com fever of the late 90s, each economic boom fosters an atmosphere of unbridled optimism, where risk is cast aside in the pursuit of exponential returns. The late 2010s and early 2020s marked such an era for digital assets. Cryptocurrencies, once the domain of niche enthusiasts, exploded into mainstream consciousness. Billions, then trillions, flowed into this nascent market, driven by a narrative of financial liberation and a belief in a truly global, unburdened economy. The mantra was, "Move fast and break things," an ethos that blurred the lines between innovation and recklessness. This was the vibrant, yet volatile, backdrop against which one of the most audacious financial schemes of our time would play out, promising to revolutionize finance, but ultimately exposing its rawest, most ancient flaws. It was a digital gold rush, attracting both genuine visionaries and cunning opportunists, setting the stage for an inevitable reckoning. To grasp the scale of the deception, we must first understand the fundamental mechanisms it exploited. At its core, the fraud was perpetrated through a seemingly legitimate cryptocurrency exchange, a digital marketplace where users could buy, sell, and trade various cryptocurrencies. This entity, much like a traditional stock exchange, held vast sums of customer assets, operating on the implicit trust that these funds were secure and segregated. However, this trust was systematically betrayed. The modus operandi involved a sophisticated misappropriation of customer deposits. Instead of safeguarding these assets, they were allegedly diverted and lent out to an affiliated trading firm. This is akin to a bank using its depositors' funds not for regulated loans, but to gamble aggressively in the stock market with little to no oversight. The deceptive financial reporting was central to this charade. On paper, the exchange claimed solvency, maintaining a facade of robust financial health. However, the reality was a meticulously crafted illusion. This involved manipulating balance sheets, creating undisclosed liabilities, and concealing the sheer extent of the intercompany loans. Forensic accountants, when they eventually stepped in, faced the daunting task of untangling a deliberately complex web of transactions, spanning multiple jurisdictions and entities. They relied on ledger analysis, meticulously reconstructing transaction histories, data mining through vast datasets, and even attempting blockchain tracing where applicable. However, the opaque nature of private companies and the lack of robust internal controls made this a colossal challenge. The scheme also exploited regulatory loopholes inherent in the nascent digital asset space. Unlike traditional financial institutions governed by strict statutes, many cryptocurrency entities operated in a regulatory gray area. The inevitable unraveling began not with a bang, but with a whisper, a series of whistleblower alerts and leaked reports questioning the stability and solvency of the affiliated trading firm. These concerns, initially dismissed by the perpetrators as market FUD, fear, uncertainty, and doubt, steadily gained traction. The psychological landscape of the market shifted from speculative optimism to acute anxiety. Users, prompted by growing rumors and increased scrutiny, began to lose faith and initiated widespread withdrawals from the exchange. This created a classic run on the bank, a self-fulfilling prophecy of collapse. An exchange, even one claiming substantial reserves, cannot withstand a mass exodus of its underlying assets if those assets have, in reality, been secretly siphoned away. The moment of truth arrived swiftly and brutally. As withdrawals accelerated, the affiliated trading firm, deprived of its illicit funding source and facing massive losses from its speculative bets, could no longer service its obligations. The dominoes began to fall. The public revelation of the exchange's severe liquidity crisis sent shockwaves across the entire digital asset ecosystem, triggering a market crash that wiped out billions in wealth overnight. The realization dawned on countless investors, from individual retail participants to sophisticated institutional players, that their digital assets were, in fact, non-existent, their accounts reflecting mere phantom balances. The betrayal was profound, shattering not just financial portfolios but also the very trust upon which the new digital economy was being built. The promise of a transparent, immutable ledger had been undermined by very human, very ancient forms of deceit. The market reaction was visceral, characterized by panic selling, plummeting valuations across the board, and a collective gasp of disbelief as the scale of the fraud became undeniably clear. In the harsh light of the aftermath, the full legal and ethical implications began to materialize. The entities involved faced a barrage of civil lawsuits and, crucially, criminal prosecutions. Prosecutors, navigating the complexities of applying established financial crime statutes to novel digital asset structures, invoked principles seen in cases like the Madoff Ponzi scheme. While the technology was new, the underlying crime, illicitly taking and using customer funds, was fundamentally familiar. The Sarbanes-Oxley Act, enacted in the wake of the Enron scandal, underscored the critical need for corporate accountability and robust internal controls, lessons that were acutely relevant to this digital debacle. The fallout exposed significant gaps in oversight, particularly regarding integrated digital asset monitoring. The incident served as a stark, undeniable call to action for regulators worldwide, prompting tighter disclosure rules and accelerating the development of specific fintech regulations. The philosophical lesson is clear: while innovation drives progress, it must be tempered by robust governance and ethical frameworks. The allure of uncharted territories in finance often conceals the timeless risks of fraud. Preventing future market crashes and corporate scandals requires not just new technologies, but a renewed commitment to transparency, accountability, and the unwavering enforcement of laws designed to protect the integrity of financial systems, whether they be analog or digital. The journey towards a truly secure and equitable digital economy demands vigilance, for the human element, with all its inherent flaws and aspirations, remains the ultimate constant.